What is the best way to gift money to the next generation while still keeping taxes low and flexibility high? Many families really want to help their kids and grandkids financially, but they're not sure which accounts give them the biggest bang for their buck. Okay, today we're breaking down the pros and the cons of 3 powerful gifting tools: the 529 plan, UGMA and UTMA accounts, and Roth IRAs for kids with earned income. If you're like me, your parents did not even know about these accounts. Welcome to Growing Her Wealth, the show that gives women like you the practical solutions and honest answers you need to help sustain yourself and your wealth throughout your life. I'm your host, Danielle Meister, a wealth advisor with Madrona Financial and CPAs. I take you full spectrum from the psychology of wealth to investments, tax, real estate, private equity, estate planning, and beyond. If you've ever felt unsure about how to support a child or a grandchild financially and not create a tax mess along the way, you're not alone. I've seen so many families come to me saying that we really want to help with their grandchildren, and we want to help with retirement or even college funding, but we really don't want to screw this thing up. And I honestly get it. We have a 5 and an 8-year-old. And with our daughters, what we did when we first started is we looked at each other and we were like, okay, so where do we begin? We've got lots of choices out there. And it makes sense because the accounts come with very different tax rules, flexibility, and control along the way. And here's the part that a lot of people don't realize. The best account depends not just about the money, okay? It's about the goal that you have and what you're trying to accomplish. So let's start with 529 accounts first. A 529 account, it's just a tax-advantaged account, and it's designed for educational purposes. It lets the money grow tax-free, and the withdrawals are federally tax-free when used for qualified education expenses. All right, that's going to include things like education, room and board, books, and fees. And in 2025, you can give up to $19,000 per beneficiary, and that's actually $38,000 for married couples, and there's no gifting tax. You can even super fund this. So, sometimes we'll have grandparents that come in and they want to do a much larger gift. And so what the rule says for 529 accounts is that you can super fund up to $95,000 per person. And what's crazy is it's up to $190,000 per couple. And the gift is it's designated to be over the course of 5 years. So big funding opportunities. There's some additional rules to that. Just make sure to research before diving in. And starting in 2026, under the One Big Beautiful Bill Act, a lot of families can start to use this money and up to $20,000 from the 529 account for K through 12 tuition. And the range of qualified expenses has expanded way beyond tuition. So it's going to include things like online learning and tutoring costs, which is huge for a lot of families that want to do outside tutoring, and then educational therapies for students with learning disabilities or disabilities in general. Guys, this is a huge win for families. And so I think about this for my family, for example, and we just got done with having parent-teacher conferences, and one of our daughters is a little bit behind in Spanish. We're thinking about adding in a Spanish tutor because we're at a public school that does dual immersion, and we want to make sure that she's not falling behind. So the 529 account can actually be used in this way now. So I just want you guys to start thinking outside of the box for how can these 529 accounts actually be used starting this year and into the future. Another new feature for 529 accounts, and this one is going to be for kids who are a little bit older. So let's say that you never used all of the funds inside of the 529 account. You've graduated from college, or maybe you decided not to go into college at all, but you decided to get into the workforce. So one of the, in my opinion, most awesome things that the new rules say is that up to $35,000 of the 529 account can go over into the child's Roth account. There's a couple of rules. For example, the Roth account must be opened for at least 15 years. And you have to have earned income. So think about it like this. If you're thinking about maybe transitioning and thinking you want to transition at some point in the future, open a Roth IRA account as soon as your kids are babysitting or mowing lawns. to get that Roth IRA, get the clock going so that that 15-year timeline has passed by the time you want to transition the $529 into the Roth. And shoot, it doesn't matter how much you fund it with, just get a low dollar amount in there to start that clock. Okay, a few additional considerations when it comes to 529 accounts. If you use the funds for what they consider non-qualified expenses, you could add taxes and penalties. And the owner, not the child, controls the account. And the last thing is that if you overfund it, you think, gosh, there's way too much money in this thing. I've got several kids. You can roll the money from one kid's account to the next or another family member. So it even works with cousins and outside just the immediate family. So what did me and my family do? What did me and my husband decide? We opened a 529 account when our oldest daughter was born. And we set up just a monthly funding amount. For us, set it and forget it is a really good way to go so that it's not difficult to manage. We're 8 years in and it's grown 225%. That's the magic of compounding growth and what I want to introduce you guys to. Okay, we talked about 529 accounts. Let's talk about UTMAs and UGMA accounts. That just stands for Uniform Gift or Transfer to Minors Account. So the T and the G just depends on what state you live in, but essentially they're the same thing. It's simply a custodial account that allows you to gift assets to your children, and then you keep control until they are adults. Okay, so an UTMA or an UGMA, they're flexible. The money can be used for anything. It's not just education. And there are no income or contribution limits other than just the annual tax-free gifting limits, so that if you want to gift more, say more than the annual gifting amount at $19,000, it simply reduces your federal estate tax exemption. So I'm going to pause here and do a little left field. If the federal exemption is $15 million, okay, and you want to gift your child $100,000, okay, your federal tax-free exemption, and you take $100,000 out of your federal tax-free exemption, you take that $15 million down to $14,900,000. You just have to file a tax form 709 to report it. This is a huge planning opportunity for people living in states like Washington, because what it essentially allows you to do is you can take money out from your state gifting limit, okay? And what I mean by this is it's removing money from the taxable estate at the state level. It does not reduce your state exemption. It only reduces the federal exemption. So it's a huge estate planning strategy. Okay, we'll talk about that another time. Coming back over to the UTMAs and the UGMAs, there are trade-offs. Once you contribute to it, it's legally the child's money. And when they reach the age of, they call it the age of majority, which is sort of a weird term, but it basically means when the child turns 18 or 21, depending on your state, they get full control of it. You lose control. And the other thing is that these accounts can impact financial aid calculations since the assets are in the child's name. Okay, let's talk about who's using these. Some of my clients are using UTMAs and UGMAs because it's a really awesome way to set aside money that's not specific to education. My caution here is that if my kid ends up being a total knucklehead and I don't want a pot of money getting handed over to them so they can spend however their heart desires, then this account becomes a little bit tricky because legally it's theirs. Okay. Finally, number 3 account. Let's look at Roth IRAs for kids. It's an amazing opportunity when a child has earned income. So think of a summer job like babysitting and mowing lawns, part-time jobs, and when they get older, it can be full-time work. A Roth IRA allows you to do contributions that grow tax-free, withdrawals in retirement, also tax-free. And even if they needed to get access to the contributions, they could get the contributions, the money you put in, at any time. It's one of the best ways to give a really young person or somebody just starting in their financial career an awesome head start at retirement and the power of compounding interest over time. Okay, there's a couple of rules, and let's just go through them quickly because the child must have earned income. So if your kid's mowing lawns, if they're babysitting, the earned income must be equal or higher than your contribution amount, and the contribution amount is $7,000. in 2025. That just means that if you want to put $1,000 into the account, the child must be earning $1,000 or above. If you want to max out at $7,000, the child must be earning at least $7,000, if that makes sense. I want you to think of this as more of a long-term planning tool, and you're setting your child or grandchild up for a tax-free retirement. I mean, guys, how cool is that? So again, really awesome planning opportunity. I've seen a lot of people say, once a child starts working, that maybe the parents or the grandparents will match the child. So if the child's earning, let's say they're earning $5,000 and they're just getting started with earning, and maybe you say they put away $1,000 and you match them $1,000 or $2,000. It's just a really good way to help start teaching children about matching and growing wealth. So I'd love you to think about that for your kids. So how do you choose the right strategy? You guys, it's a really simple framework. Think about it like this. 1, if your goal is education, 529 account. 2, if your goal is flexibility for maybe purchasing a home or going out and purchasing a car, use that UGMA or UTMA account, those custodial accounts. And 3, if you want to help a teen or a child or even one of your grandkids, kids that's getting into the workforce, and you want to build long-term wealth, potentially even into retirement, use that Roth. That is the most powerful tool for tax-free growth along the way. And guys, a lot of families are using a mix. The key is not how much you give, it's strategically how you give and picking a strategy and sticking to it over the years. Try one of these approaches this year, and you'll really help the next generation get set up for way more financial independence than I think a lot of our parents were able to do in terms of setting up accounts really early on, back in the 80s. So let's build on this in upcoming episodes. I want to talk more about advanced gifting strategies like donor advised funds, charitable bunching, qualified charitable distributions. That's another one I love. But for today, thanks for spending time with me on growing her wealth. If today's episode helped you, share it with a friend who also needs to hear it. Maybe another mom or a dad, grandparents. Guys, though, this show is not to be considered financial advice. If you're looking for personalized financial advice, go to my website, growingherwealth.com, and just click the Let's Chat button. And until next time, keep growing, keep learning, and keep building your wealth.